So now we are going to solve the question of the RAM company. So that for 10 marks we have to show the impact of transactions on assets, liabilities and equity. So I have made a table. The business has started with rupees 3 lakh as cash. So we'll add 3 lakhs in cash and also 3 lakh in equity. It is said that the company rented a furnished office for rupees 12,000 and paid rent for the month of May. So 12,000 will be deducted from cash and 12,000 from equity. As it is an expense, you have to deduct it from equity. Remember that all the expenses are to be deducted from equity and all the incomes are to be added in equity. May 3, the company purchased equipment for rupees 1,50,000 in cash. So cash balance will go down by rupees 1,50,000 and equipment balance will increase by rupees 1,50,000, and there will be no impact on other transactions on other accounts. Merchandise zero effect, trade receivable zero effect, equity zero effect, liabilities zero effect. Then also we had a transaction on May 3 of purchasing merchandise worth rupees 2 lakhs on credit. So 2 lakh worth of merchandise has been purchased, so I added 2 lakhs in merchandise and I also added 2 lakhs in liability. As we have not paid cash for it, we have taken it on credit, so it is trade payable basically. Then on May 8, the company sold merchandise worth rupees 60,000 for 95,000. So from merchandise was reduced 60,000 rupees, and then we received 75,000 rupees as cash. So 75,000 rupees in cash. The total sales made was 95,000 rupees, out of which 75,000 is received in cash. So the remaining 20,000 is trade receivable. 20,000. So we have to show the net effect, that is the net profit made on this transaction. 75,000 plus 20,000, which is 95,000 minus 60,000, is equal to 34,500, which is added in equity. Then on May 12, we sold merchandise worth rupees 50,000 for 84,000 in cash. Again, from merchandise you have to reduce rupees 50,000 because the stock is decreasing, and you sold it at 84,000 in cash. So 84,000 is added in cash. Net effect, that is the profit, is shown in equity side. In equity we add 34,000. On May 15, the company paid rupees 1,25,000 towards purchase of merchandise. So basically it is paying back the liability. As on May 3 you purchase merchandise worth rupees 2 lakhs. So out of 2 lakhs you are now paying around 1,25,000. So you are repaying the trade payable. 1,25,000 deducted from cash, 1,25,000 deducted from liability side. On May 20, the company received rupees 20,000 for credit sales made on May 8. So May 8 is this 20,000 rupees which was trade receivable, we are receiving it now. So we'll reduce the trade receivable by 20,000 and add 20,000 in cash. No effect on other accounts. May 22, the company sold merchandise worth rupees 70,000 for rupees 1,06,000 on credit. 70,000 will be reduced from merchandise and 1,06,000 will be added in trade receivable. And the net profit, that is 1,06,000 minus 70,000, which is 36,000, is the profit which is added in our equity. Then on May 25th, the company received 40,000 cash towards sales made, 40,000 in cash and 40,000 deducted from trade receivable, as it pertains to the transaction May 25th. So on May 25th towards May 22, so we had sold merchandise worth rupees 1,06,000 on credit. So out of 1,06,000 we are receiving 40,000. So that is shown in cash and 40,000 deducted from trade receivable. Then we have company paid rupees 50,000 cash towards merchandise purchased on May 3. 50,000 deducted from cash, 50,000 deducted from liability, as you are clearing off your trade payable to the extent of rupees 50,000. May 27th, company purchased rupees 75,000 worth of merchandise. Again you add 75,000 worth of merchandise in the merchandise account, and liability is getting increased by 75,000, and as you have not paid the person yet. Then on May 30th, the first transaction is paid rupees 25,000 cash for salary. 25,000 to be deducted from cash, 25,000 to be deducted from equity. As I have said earlier as well, expenses are to be deducted from equity. and incomes are to be added back into equity. Then we also paid for telephone bill 2500 deducted from cash, deducted from equity. Then 3500 for utility bills, electricity bill. So 3500 from cash, 3500 from equity. On May 31st, we again have three transactions. First is wages, but in this case, the company has to pay wages for rupees 5000. It means the amount is not yet paid. So liability will be increased by 5000 because you have not paid someone yet. And again, as it is an expense for the month, so you will deduct 5000 from equity. Then we have depreciation on equipment. Depreciation is to be deducted from the equipment. We have equipment worth rupees 1,50,000. From it we will reduce 3250 amount, and again, as depreciation is also an expense, we will deduct it from equity. And then the last transaction, company paid dividend. Dividend is paid in cash to Mr. Gopal. So dividend is deducted from cash 7,000 and from equity as well, because you are paying it out of retained earnings. So 7,000 is deducted from the equity portion. So these are the balances that we arrived: 1,44,000 cash, 1,46,750 equipment, 95,000 merchandise, 66,000 trade receivable, liability is 1,05,000, and equity is 3,46,750. The total comes around 4,51,750 on both sides. Thank you.